Morning, viewers. This is your tutor CPA Charles Cafield, and today we are going to start our series on financial management, that is CPA paper 10, level 2, and we are going to kick off and we see how we can be able to understand financial management, and we see how we can put it in practice. So without wasting more time, let's proceed. And we are saying financial management, it's one of the aspects that were found necessary to keep them separate and to assign to it within the organization a person that can be able to interpret and find how the organization can be improved on its performance, and that's the financial manager. And we are going to be seeing how that person relates the information that was prepared by the cost accountant, financial accountant, and the tax. We try to see how we can look at how we can be able to finance the organization. And we are saying financial management, this concerns with the raising and allocation of financial resources within the firm in order to achieve the firm's objective. The reason why we are looking at financial management, or we are separating the financial management from all the aspects of finance, is that this is mainly concerned with the raising. How are we getting the financial resources, as in terms of the short-term and the long-term resources or funds that are going to be able to support the operations of the organization. And we are looking at a scenario whereby, having got those raw materials, those resources in terms of money, how are we going to allocate that money and we'll be able to do the operations, and we'll make sure we maximize everything and we'll get maximum revenue vis-a-vis minimizing the costs that are going to be incurred within the organization. That's the big emphasis that is embarked within the financial management aspect, and we are trying to look at it in a broad view. When we talk about the broad view, we are trying to look at how the organization, because the process of raising resources, it involves so many aspects. That's the financing decision part of the business, and it involves so many things that, having got even the money, you have to look for where you are going to be investing that money so that you can be able to maximize the revenue and reduce the costs. That's why it is defined that way in the broad view. But if you want to look at it in a narrow way, or a narrow view within something that is a bit very brief and very direct, is that we are trying to look at how this finance function is going to help us. We perform what we are doing within the operations of the company, but we make sure we use the money that we've acquired efficiently. That's in a narrow view. How are we able to utilize the funds we've got so that we'll be able to minimize the costs, and we'll be able to maximize our revenue from the resources we have invested in the business. So in the narrow view, we are saying financial management refers to the routine function which are performed within the firm to ensure efficient use of funds. And these are some of the activities that are performed within the organization that we expect. If we take into consideration the financial management aspect, we are able to utilize the funds that we've sourced from different platforms. We'll be able to use it and we maximize the revenue and we minimize the costs we are going to be incurring. These activities, they may include acting as a treasurer of the business. And acting as a treasurer of the business, we are going to be seeing the role of a treasurer within the organization. And one of them, they are managing exchange rates and planning cash and all that stuff we are going to be seeing as we look at the some of the roles that are performed by the treasurer within the organization. But you have to first know that a financial manager will be acting as a treasurer of the business. Secondly, supervising daily cash receipts and expenditures. We are looking at how we are receiving the money and how we are spending that money we've received. Remember, our major aim is to make sure that we maximize the profit and we minimize the costs that we are going to be incurring within the production. And the other one we are talking about is custody and safeguarding of the firm's valuables. Firm's valuables, they may be in terms of the investment. We'll be able to keep the policies within the insurance. If let's say we are paid for certain insurance, if let's say we have acquired some expensive items that need to be kept safe. Then the other one is settling claims. Of course, when you have, let's say you are supposed to be paying clients, you have tax obligations that you want to be offset, you have other payments that you need to make in regards to the company operations. Then the other one, managing exchange rate and fluctuations, how these exchange rates are changing. Because remember, when these exchange rates are changing, we expect that the company will be affected in the other way or in one way or the other. Because if the exchange rates are increasing, we expect that if at all we've been selling items, we will be able to know the gain on the realized gains on gains and losses on foreign exchange. In terms, if let's say you've been demanding someone and that person is supposed to be paying you in a different currency, and when that person pays you, find that the money you've been owing that person, the money you've been demanding that person, you find that it may also go high or it may reduce depending on how the currency of that person is changing. So we are going to be looking at that. But what I want you to get in mind is that when we are trying to look at financial management in a very broad aspect, we are trying to look at not only how the money we are raising, it's not that we are just looking at how the money is raised and how it is allocated. But what we are trying to look at is we make sure that the money we've acquired, we allocate it very well, and we make sure we use that fund effectively. And we make sure that we can be able to maximize each and everything in terms of the revenue, and we minimize the cost that we are going to be incurring within the production. So what we have to look at, if you try to look at the broad aspect, you are saying that not only must funds be raised and allocated within the organization or the firm, but also the day-to-day efficient use of resources must be ensured. And to do that, then we have to employ the financial manager has to make some decisions, and those decisions, they are done in regards to finance. And some of these major finance decisions, we have the investment decision, that's the capital budgeting decision, we have the dividend decision, we have the working capital management decision, and finance decision. Those ones we are going to see each of them in details. And to give you a brief of what we are going to be looking at, we are going to look at the major finance decisions. We look at them in details. Some of them we shall even go into their computation, like the capital budgeting decision, that's the investment decision. We are going to look at each and everything, and those are the components that are making up financial management. So by the end of at the end of the discussion about the financial management, we must be able to look at the investment decision itself. We try to get the computations, how we can be able to get the long-term assets that can be used in the production process. Those ones I'm going to explain, but we are going to go further and analyze each and everything, how the dividends are shared, and how the net profit is shared, a portion to retain the earnings and a portion to the shareholders, and how are we looking at our working capital. Working capital, those are the day-to-day operations. How are we handling our short-term assets? Then the other one is financial aspect. Of course, where are we getting the sources of income we are using within the organization? That's all we are going to be looking at. But our major emphasis, or our major role as to why we are looking at these major finance decisions, is we want to make sure we raise the funds, we allocate those funds within the organization appropriately, so that we can be able to efficiently use those resources that we have acquired to make sure we can be able to achieve the objectives of the stakeholders. Okay, we can proceed the next slide, and we try to look at the nature and role of the financial management. Now, these are some of the roles a financial manager is supposed to be handling when you want to maximize the stakeholders' obligations within the business. So we are saying financial management is responsible in the organization. Now we are looking at the role of financial management as in a broad view. We are saying that financial management's responsibility in the organization is to ensure that the organization has funds to carry out its operations efficiently in order to maximize the value of shareholders of the business, or to satisfy the objectives of its stakeholders. This comes from what we've discussed as in the general view here. You are seeing the main emphasis is to raise the resources and we allocate it within the organization effectively, so that we make sure that we get we satisfy the stakeholders, and these stakeholders, we shall look at them, but those are the people that use the financial management information. And we are saying that some of these, how you can be able to allocate the funds we've got, and you make sure you maximize the values of the shareholders of the business. We are saying that we have to raising funds to enable the organization to acquire short-term and long-term assets to enable it operate. When you get these short-term and long-term, remember these short-term assets, they are our working capital management. The long-term, those are the investment aspect or the capital budgeting decisions. That's where we make those decisions. But the main aim is to raise the fund. When you are raising the fund, that is the financing decision. So we are raising the amount, and we make sure we enable the organization to acquire the necessary equipment or machines that can be able to operate and produce the goods and services that can be given out to the customers, and we try to maximize the profits. The other one is allocate the funds. Remember, here we are talking about the roles of financial management, and we are saying, first of all, we have to first raise the money. When we raise the money, then we allocate those funds we've acquired. Allocate funds effectively so that the organization can produce the required goods and services in the most effective manner in order to maximize returns while minimizing the risks. When you're allocating when you're trying to allocate the funds we have acquired, you may be either trying to allocate that fund maybe to buy the long-term assets that can be used within the organization, or the short-term aspects. And we are saying that if you're acquiring those long-term assets, they must be functional to the extent that you've also determined their returns on investment. If we put in our money, have you confirmed that we are going to be able to make profits out of it at a least cost, when we are incurring at least a risk which is not too high to the extent that it can make us lose the business? That's exactly what we are looking at. We allocate the funds, but we make sure we are allocating the funds to those assets that can be able to provide more profits, and they are at a minimal risk. Okay, the next one is the effective manner referred to above. That's in the allocation it requires the financial manager to identify the stakeholders in the business and meet the interest or objectives of the stakeholders in the business. What we are trying to look at when we are allocating these resources is that we allocate the resources to those assets that can be able to make sure we produce the goods that are needed within the market. We maximize our returns. And remember, the main aim as why someone wants to engage in business is to make profits. Those ones we are going to look at them as we see the objectives of the business. And we are saying, having allocated the money, remember here, we only have these laws, we have only three. This fourth one, it is only this, and the last one. This one is just a continuation of this, but you can give it as a separate point. But the main points we have four. First of all, we raise the money. Secondly, we allocate that money we've got. And thirdly, we control. When we are trying to control, it's because we are expecting now to be getting the money. But when we are doing that operation, it means we have to control certain costs that may arise within the operations. And we try to look at how the funds are going to be lined to that aim that will take us to giving the shareholders what they want, or the stakeholders, the different stakeholders. And now we are saying that the success of financial management is judged using the extent to which the above four responsibilities have been successfully attained. And here we are saying, when we are raising the funds, we efficiently allocate the funds we've raised, and we make sure that we have effective control and we are meeting the obligations of the stakeholders. We are expecting that the business is going to be perfect and we are going to be getting our revenue, maximum revenue, and we reduce our costs. Because when you are getting the revenue, we are expecting that the performance of the company is going to be improving. And that's what the stakeholders want. Because you look at the different stakeholders. When I talk about the stakeholders, those are the different people that may get interested in the business. We may be having the government, we may be having the public, we may be having the shareholders, we may be having financial institutions, and we see how each of those ones is able to look at how we can be able to get what they want. And that's what we are looking at when we see the roles of financial management. And having known those ones, but remember I said there are 3, but this 4th one comes in because it's what makes the business stand out. Because if you're not giving the stakeholders what they want, then it means you are doing nothing. Because we may allocate the funds well, we raise it, and it was very convenient for us to raise it, and we've made sure that we've controlled everything. But at the end of the day, we find ourselves not giving the stakeholders what they want, or the main aim as to why they formed the business into place. We are not doing it. So those are the roles of financial management. So now let's go to some of the major finance decisions. We said in the part 1, in the first slide, that if you are to make sure we raise the funds well, we allocate the funds well, and we make sure that we efficiently use or we control that finance, we have to come up with some decisions. The financial manager has to make some decisions, and these finance decisions, we are talking about them into the investment, dividend, working capital management, and the financing decisions, as we are going to look at them. And we see how each of them is contributing to our major objectives or our major role as financial managers. And we are saying that the major financial decisions or roles of a financial manager. Remember, these are the ones the financial manager is supposed to do. He's supposed to make sure he or she does each of these decisions perfectly, so that we'll be able to maximize what the stakeholders want. If these ones are done wrongly, we expect that we are not going to achieve what the stakeholders wants us to achieve. One of them, we are saying it is investment or capital budgeting decisions. This investment or capital budgeting decision is one, for it is concerned with how we are going to be investing the money we have in terms of the long-term assets. Here we are looking at the long-term assets that are going to be used in the production process. And how do we come up with the decision that will make sure we invest in these assets? One, we have to look at that these long-term assets can be able to provide us the maximum returns we want them, if at all we commit our money into them. Secondly, we have to look at the timing of those returns. How are they going to come in? We put in the time value of the money, and we see it that if I put in 10 million now, how long will it take for it to give me back the returns in terms of the payback period? Those ones, we are going to look at them in the further analysis, but here we are just going to look at the introductory part and what is it, what is this decision about, and we shall look at it in the broad detail as we go to handling each of the finance decisions separately. Now we are saying that investment or capital budgeting decision, this involves the firm's decision to invest its current funds. It means that you cannot go for the capital budgeting decision when you have not done the finance decision where you raise the money. You make sure you have raised the money first, then you go in by looking at where you are supposed to invest that money you have acquired. This says it involves the firm's decision to invest its current funds most efficiently in long-term assets. We are saying long-term assets in anticipation of unexpected flow of benefit over series of years. And what does this mean is that we are looking at which long-term assets are we going to invest in our money. When we have known that, then we see what will be the expected the inflows. What will that asset bring to us as a benefit? And we look at it within the time aspect. If you don't put in the time aspect, then it will not be helpful, because when you are looking at, if let's say someone tells you I made 10 million, but that 10 million was in 10 years time, that I'll get 10 million in 10 years time, it doesn't make sense when you try to look at what will be the present worth of that 10 million. What will be the present worth of that future 10 million we are expecting? You will see that when you try to convert it within the present value, its present worth, you will see that it will not be anything. You rather give me 1 million as a profit today because of the time value of money. You know, when there is that time value of money, we expect that money, if I get it now, I can do further investments. I can even eat that money, because at the end of the day, if you tell me I'm going to give you 10 million in 10 years, I may not even reach there. I may die before reaching there. So it's the time value of money aspect. It looks at the demand for money, as in why people prefer money now than later, as we shall see those reasons. But here we are saying the investment decision involves the firm's decision to invest its current funds most efficiently in long-term assets in anticipation of unexpected flow of benefits over a series of years. Remember, the long-term assets, they take long, so in that period they will be giving us returns. So we are proceeding, and they're saying by determining the nature of the business, because those long-term assets we are acquiring, they are the ones that form what the business will be. If the business, let's say, is about banking, we start buying, let's say, computers, furnitures, and all of that. If the firm is within the, let's say, sugar manufacturing, you find that the assets we are acquiring, they can only be used to manufacture sugar. So those assets we've got, they are the ones that form the asset mix of the company, or they give the general picture of what the company will be doing. And we are saying that the investment decision shapes the business risk of the firm. This business risk is in terms of what the business is trying to engage in. If it is sugar manufacturing, if it is cement manufacturing, and all of that. you know, when you select, if let's say it is a sugar manufacturing farm, you just find that there are other associated risks that are involved within the sugar manufacturing. So these assets, they shape the business risk of the farm. That is to say, the likelihood that the earnings of the farm will fall or increase due to the type of business it undertakes. When you're doing the business that is too risky, we expect that you are going to be getting higher profits, but at the end of the day, we expect that there is a high chance of the business collapsing. And we are saying, for example, the investor who acquires permanent assets. Now we are looking at some of these. We are looking at some of the businesses. The investor who acquires permanent assets in the fashion industry will face high fluctuations in earnings when customers' tastes change than one in the industry of making essential products. Here we are trying to look at the risk that is involved. If let's say someone sets a fashion industry, and that fashion, you know, something which is fashion based, it means when the customers' tastes or what they feel about the product changes, it will affect how the person will be earning. If there is technology, we are saying, sorry for that, we are saying the financing decision is, this involves decision on amount of funds required and the various services involved in providing those funds we need. One of them may be the period of financing. If you are going to be getting the money from a loan facility or a financial aid, and we are going to get the money from the bank, we are looking at how much will it be for us, how much it will cost us to get that loan. And secondly, we look at if they are going to give us a loan, it is going to be in which period. Are we taking a long term or we are taking a short term? Then the other one, having known the way we are going to be getting the money, then we don't stop there. We look at what will be the returns on those funds we are acquiring. Are we going to be able to get the money, as in when we've looked at where we are going to invest the money, and we try to look at our inflows so that we can be able to compare that the interest rate that we are going to be paying in the bank will not be higher than what we are going to be earning as in the profit. Then the third one, we are going to assets. We are looking at the short-term assets that are going to be used within the organization to help the organization run its operations. And we are saying this involves an optimal amount of short-term assets the company should maintain in order to operate the long-term assets. These short-term assets, they may include the debtors. We may include we may be having even the cash we have, so that we can implement the long-term assets we acquired in the investment decision, make sure that we produce everything as we wanted. So the last one is the dividend decision. This dividend decision is all about how are we going to be distributing the net profit we've got in the operation, the business operations, and we look at what will be the portion that will be taken to retain the earnings that will be kept within the organization to finance its growth, or what will be the portion that we are going to be giving to the shareholders as in dividends that is paid to them for their money they contributed in the business. And here we are looking at what proportion is going to be left within the organization and what will be given out as in dividend to the shareholders. Here we are saying this involves the appropriation of earnings at the end of the operating period, that's the net profit. This seeks to determine how much of the earnings should be retained in the business to finance further growth or to be distributed to the owners as dividends. We are going to look at each of those decisions in broad view because that's what we are going to be looking at as for now. And don't forget, our main aim is that we are looking at how we can get those resources. We make sure we allocate them efficiently and we achieve the stakeholders' obligations or what they want us to achieve. Those are the objectives of the share of the stakeholders, and we also try to control those operations, and we see that we can be able to minimize the costs that are within the production. Okay, now we are going to be looking at what is the importance of the financial function. If you are if you have understood what I've been discussing, then you'll be able to answer the question that will be asking you, what is the importance of finance function? This finance function does what we've just finished as in the finance decisions. Those are the ones they do. So how can you rephrase those points and you'll be able to answer this correctly? I gave you some here of how we can rephrase them. We are saying estimation of the capital requirement. Estimation of the capital requirement, here we are looking at what will be the composition of the capital that is needed within the business and its expected returns. Here we are saying that estimation of capital requirement, a financial manager makes an estimate of the capital required of the firm or required by the firm. This will depend upon expected cash flows of the enterprise. Here we are looking at the cash flows, we are looking at them in terms of the inflow and the outflow. What will be coming in and what will be going out. We expect that if you are going to be spending more money, then we may need more money, as in terms of what we shall be engaged in will be requiring us to pay a lot of money, so we shall be able to get more capital so that we can make sure that the operations are running smoothly. Then the other one is determination of capital structure. The other one was capital requirement. How much do we need in the business operation? But this one, the capital structure, it is looking at how is that funds are going to be sourced. Is it from the owners or is it from the borrowed money? Here, we are saying this will entails short-term and long-term debts, equity analysis to establish the cost versus the returns on each mode of financing. We are looking at having known these finances, where we are going to be getting them, but what will be the return on them? Then the other one will look at the choice of the source of finance. The other one was capital structure, whereby it was only looking at the debt to equity or to owners' equities contributions. But here we are looking at the sources. These sources, they are going to be the addition. Remember, we have already got the capital we need in the business, but we are looking at the additional sources. Where can we get more income as we need them? Are we going to be going for the short-term loans? Are we going to go for long-term loans in case of providing additional finances to what we already have in the business? Because here they are saying this involves the choice of suitable sources of additional funds for smooth operations of the company. Here we are looking at what can be the other sources we can use to add in more capital or to add in more money within the organization. And the other one is talking about investment of the funds. When we've got that money, then the financial manager has to also to make a decision on how to allocate that money appropriately in profitable ventures. How do we determine that these ventures are going to be profitable? That one we shall look at it when we go deep into the capital budgeting decision or the investment decision, and we see how we determine that this business is going to be profitable for us. Then the other one is appropriation of surplus or net profit. That is the dividend decision. Here, the financial manager has to make decisions on how the net profit we've got in the business operation is going to be distributed, either by retaining some money so that we can further our growth and investment, or we pay some of the money to the dividends, depending on the prevailing situations. How do they determine that this money should be kept? It depends if the company has desires of growth and investing in other ventures. Then the other one is cash management. Here we are looking at how the financial manager is going to be able to look at how are we able to maintain the cash within the organization, because that cash, if you maintain cash, the reason why we demand cash in the organization is, one, we want to pay the daily operations or the daily expenses that may incur. Others may just look at the cash in terms of paying the salaries, because if you don't make you don't retain some of the money, you'll find that some of these expenses, they may come as urgent and you can't even pay them because you don't have cash. And you know the other reasons of holding cash, you may find that you want to buy some goods, you've got a supplier who is selling you these goods at a very good discount, and you find yourself you don't have cash. So those are some of the things we look at, and we see that we demand for cash in the organization. The other one is finance control or financial control. Here the financial manager exercises the control through ratio analysis. We are going to look at those ones: ratio analysis, financial forecasting, costs and profits. Those ones we are going to look at them, how we determine those projected or the forecast income statement and all that. We shall look at them. Then the last one is profit planning. When you have got a profit, what we want, if let's say in the other financial year you've got a profit, we expect that in the next year, we expect you to make a plan of how you are going to exceed what you got last year. That's profit planning. You make sure you look at how you can improve what you did in the previous periods. You make sure that you're able to earn more profits as compared to what you got in the previous period. So today I'm going to stop on this one, where we are going to be looking at, because I told you we are going to be looking at the roles of the treasurer, and we are looking at the treasury function. But remember, this treasury function, for it is mainly within the organization for the day-to-day operation. And we are going to be looking at how these operations are done. We are saying that the overall purpose of the treasury function is to manage liquidity of the organization. When we are looking at liquidity, is when money is there, to make sure that the money is available for the operations. How do we do that? We may be able to maintain short-term assets, like we have the treasury bills and bonds that can be liquidated very fast if at all we need the money within the organizations. These are some of the things we look at, and we see what will be the expected expenditures we are going to be incurring within the short period of time, and what will be the income that we are going to be using within the operations. So the role of this treasury function or the treasurer is to make sure that at least the cash is there, and to make sure we handle that cash in a very appropriate way, so that we'll be able to look at how these operations are going to be done. Here we are saying that the purpose of liquidity management. Remember, we said the overall purpose of the treasury function is to manage liquidity of the organization. When you have too much cash, when you have less, what can be done? Those are the things that are managed within the treasury. And we are saying that the purpose of liquidity management is to ensure that the organization has enough short-term funds to operate the long-term capacity of the organization without compromising the other objectives of the organization, like the profitability or overall wealth creation. Here we are saying that the reason why the financial department, the treasury function is there is to manage liquidity. And why do we need to manage liquidity is we want to be able to have the short-term funds that can help us to make sure those assets we acquired are functional and they can add value to the organization. And that's what we are going to be doing. Because if you don't have that fund that can be able to run the operation, you will get stuck and you find yourself not performing what the main objectives were for the organization. And we are saying that the treasurer manages the subset of the overall finance management function of the organization, particularly the treasury function, which is majorly concerned, and these are the concerns, or these are the activities that are done within the treasury function. And this treasury function, we are saying it is managing the subset or the subsystems. The subsystems in the organization, we are talking about the other departments. There may be need within the marketing department. They may be need of certain amount of money that can enable them to run the operations. So it will be the treasury department that will look at what is needed within the whole organization. It is this treasury function is within the finance department or finance function that is only left there to look at how these other subsidiary or the other departments within the organization, how do they operate so that we'll be able to get everything. One of the activities that are performed there, we are saying cash planning through forecasts of cash inflow and outflow and the resulting cash balances in order to ensure that these are optimally utilized. We are saying if there is cash planning, we are looking at how are we going to be spending this money, what will be our inflows, what will be the receipts, what will be the income where are we going to be getting that income to finance these expenditures we have. And having known that, we don't stop there. We look at the balance. Is this balance enough that can help us to push for the next accounting period? If it is not enough, how are we going to get in more cash? Are we going to instruct debtors to be paying us well? Or are we going to be restricting the payment to the suppliers for certain periods so that we can be able to raise money that can be fed within the production. That's what we do within the treasury. Secondly, we do the tracking the working capital requirement in the organization to ensure that it is efficiently utilized. When you've known what we need as in terms of the operating money or the day-to-day requirement of the organization, when you've known that, then make sure that you keep following what these departments are doing and how they spend their costs. We try to make sure that we are minimizing the costs that are incurred within these other departments as we maintain the output. Thirdly, we are looking at investing any cash surpluses, not only to generate maximum returns, but also quick availability when the need is, when needed in the organization. What we are looking at in this is that we are investing the cash. If let's say we had the cash balances, and at the end of the period, we remained with some money, that money can be used to invest in other short-term assets. Like I have told you, we can invest this money in treasury bills and bonds. You know, those treasury bills and bonds, they can be liquidated very fast. So that when you're making these investments, you also look at the timing. Are these assets we are putting in our money, can they bring the money as and when we need it? If it is so, then go ahead and put in the money, because you know that with the treasury bills and bonds, you can dispose them off. It depends which one you've bought, because there are some which are taking 1 year, 2 years, depending which one you want to buy, depending on the need available at that particular moment. Because if you have some cash and that cash cannot do anything within the organization, you invest it, but you make sure where you're investing that money, you can get it when the organization needs it. The fourth point we are talking about is extending credit to the company's clients. Here we are looking at, if the company has some money, it can be able to offer credits. That I have customers who need stock, but we can't, the person doesn't have cash, but we can supply because that's our loyal customer and we've been with that client, we know how the person pays. Then we can be able to give out the money, the item, and we see how we can be managing that debt. Then we are looking at how we can manage the risks associated with cash holding. You know, there is a problem. There is a problem with the cash. If cash is too much within the organization, even the people who are working within the treasury, they may even steal the money. So you make sure you are able to maintain the optimal or the needed amount within cash or within the organization in cash form. The rest should not, we are not allowed to maintain excess in terms of cash, because if you do so, people would just, if they don't steal the money directly, they may just misuse the money. It's better we look at how we can be able to have what we need, not having much and not having less than what we need. That's how we look at in terms of managing the risks when you're holding. Because if you have too much cash, even the people, if they are not employees stealing, even people outside can come and steal the money. So the treasurer looks at that. The other one is maintaining good working relationship with the providers of short-term funds. These are maybe in terms of the banks. You make sure that at least you are in good terms with those people who provide the money when it is needed. Why? Because we may reach at a point and the production needs some quick money and the money is not there. If let's say the customers have not yet paid and you find that the available stock, the available cash was all used up, you may rush to the financial institutions for assistance. And if you have not been having a good relationship with those guys, they may disappoint you and they don't give you the money as and when you need it. Because within production doesn't stop. If at all the money is not there, the people's order will be stuck and everything will be at stake. Because if you're not producing, you don't expect to be earning anything. So we are making sure that there is a good relationship with the service providers or the short-term providers of funds in the organization. The third last is ensuring the funds are raised when additional short-term funds are needed to ensure smooth and continuous operation of the organization. Here we are looking at, yes, we have the capital and we've been operating, but when we need, if at all we happen to need cash, we should be able to get the cash from other sources. That's what we are looking at. The other one is, the second last is managing the exchange rate risks on a daily basis. The reason why they are saying on a daily basis, exchange rates keeps on changing every day. The other one depreciates, the other one appreciates. You find it is ever changing, low, high, low, high, low, high. But how is this our concern? Is because we have customers who are paying using different currencies, and we want to be able to earn so that we don't make these unrealized gains and losses on the exchange, on currency exchanges. So the last one we can look at is provision of up-to-date and accurate information about the liquidity position of the organization to management, so that to have effective and efficient decision-making where liquidity is concerned. Here we are looking at the treasurer. We are looking at the treasurer so that he can provide for us what the money we have in terms of cash and other short-term assets that we can easily convert into cash. If you know that, then we can be able to make sure we make the decisions, let's say to invest or to add in more stock of those short-term assets as when we need them. That's all we are looking at in the loads or in the treasury function. Sorry, this one was supposed to be function. There is an N. You've seen that function even here. Okay, thank you for watching. And the next video is going to be about the objectives of the business or the goals of the business. And here the reason I tried to separate this is because I wanted you to get a very good, clear picture of what we are going to be looking at. What will be the roles of these stakeholders? What do they want from us, the business, or what do they want from the business they started? That's what we are going to be looking at in the next video. Please subscribe so that you'll be able to get everything and be able to improve our understandings as far as financial management is concerned. Thank you.